Hello traders, this is Leading Forex YouTube channel. Today I want to talk about margin. I'm sure you have heard of this word because I know you are an experienced trader, or maybe you are a newbie, but whatever way or which way it is, I know you have come across this word before and you've been seeing it but have not taken your time to actually find out what it is. And that is why I want to talk about it today. Margin. Don't run away because you have seen this word before and maybe you know it. Let me also tell you what maybe you don't know about this word margin. So stick and stay. I know most of you came across this channel as a result of tutorials I made on how to calculate pips and then also stop loss and then take profits. That video is still there and it is one of the videos that is giving me a lot of subscribers. So I have come to realize that a lot of people need tutorials. You want to know what is really the reality in the forex market. Reality. And so I decided to do this video because I want to tell you what is real in the forex market. Maybe you read something somewhere on a blog or you watch a video somewhere on YouTube and that convinced you to start trading, but you've not been told what the reality is all about. That is what I want to tell you today. So let's begin with margin. Now, what is margin? Margins simply means money that is set aside. Okay? Money that is set aside. Now, before you trade any currency pair, and I repeat, any currency pair, before you trade it, your broker takes a certain percentage of money aside from your trading balance. And that money that is set aside enables you to be able to trade whatever currency pair you want to trade. So for instance, you've seen a good trade on maybe Euro USD. And so maybe you want to buy it or sell. Okay? Now, immediately you enter into this trade, don't forget, there is a certain amount of money that has been set aside as a collateral, which is enabling you to place this trade. Yes, it is real. I'm telling you the reality. You want to know what is real in the forex market, right? That is what I'm here to tell you. And that money that is set aside for you to trade whatever currency you want to trade is what is called margin. Now, let me set the difference clear or make it clear here. Margin that is required of you to be able to trade any currency pair is not money that is deducted. Your broker do not just deduct the money or take it away. No. He only sets that money aside. Get the difference? Collateral. If you understand what a collateral is, if you are going for a loan and then your bank or whichever institution is requesting for a collateral, what it means is that once you finish paying the loan, you get back your collateral. Your collateral is given back to you. If you are not able to pay the loan, the collateral is used to pay off whatever loan or debt you owe. Do you get it? And that is what is called margin in the forex market. So I am sure you might have placed a trade one day and then you came back to check the trade and you realized that the trade was closed automatically. This trade was closed automatically, not by you, but your broker did. Yes. The reason it was closed automatically is because you ran out of margin. You do not have margin. So your broker was forced to close your trade. Please, they didn't cheat you. Just like I said with collateral, you went for a loan at a bank and said, okay, you are leaving your house or giving your house as a collateral. If you are not able to pay, the bank comes and then take your car or your house and then they sell it off to pay back the loan. So in that case, no one has cheated you. Is that okay? Or again, you placed a trade and then later on came back to check and realized that your whole account, and I repeat, your whole account is gone. Your account balance is 00000. You lost all the money in your account. That is what we normally say, your account is blown. Means you have blown your account. Okay? You have blown your account. Now, how did the account just blow? What made the account to blow is because you ran out of margin. So if you're a forex trader, money management is very key. And before you understand how much money to risk in the forex market, you need to take notice of margin, your collateral, how much money is going to be set aside whilst you trade that currency. You need to know it. It is very, very important. That is why I am discussing this with you. Now, let me take you back a bit and show you a screenshot. Okay? So let me go back and show you a screenshot. Good. This is the screenshot I want to show you. You will see currency pair and then you see margin requirement. I'm sure you can see that. Currency pair and then margin requirement. So if you are about to place a trade on Euro USD, you need a collateral of 2% of your account balance, or margin of 2% is required. If you want to place GBP USD, there's going to be a margin requirement or a collateral of 5% of your trading account. If you're going to trade USD JPY, there's a margin requirement of 4% of your trading account. And then also, if you want to trade Euro AUD, there is a margin requirement of 3% collateral or margin requirement that is needed in order for you to trade. These are just a few of the currency pairs. We have more than 100 currency pairs, which includes the exotic pairs and other currency pairs you know of. Some are metals, oil, and the rest. Silver, gold, indices. All these pairs have their requirements or margin requirements. There is a collateral that is needed in order for you to place a trade on any of those pairs. So now I'll leave that to you to check and look up for it. Find out what margin is required of all the currencies before you place any trade. Because if you don't know what margin is required of the currency pair you have just taken and want to trade, you end up blowing your account, or you will end up closing your account automatically, or your trades will be closed automatically because you have run out of what? Margin. Is that okay? Now, let me go back to where I left. Now, I just spoke about margin. Now you know what margin is all about. So when you go to your account balance section, you see margin. You first of all see balance. I think balance is the first thing you will see. And then you might also see equity. And then you will also see margin. And then you finally also see margin percentage. I'm sure. So when you go to the account balance section, you see all these things. Today, I won't be able to talk about equity and the rest, but I just want to talk about margin alone. Maybe in another episode, I'll talk about margin percentage or margin percentage and equity and the rest. But today, I just want to talk about margin. Okay. Now, you know it that, for instance, if you want to trade USD JPY, from the screenshot I showed to you, you know, if you are trading USD JPY, you need a margin of what? 4% of your trading account, which is a collateral. Your broker will need that before allowing you to buy or sell USD JPY. So immediately you place a trade on USD JPY and it goes through, you should know that a 4% has been taken aside as collateral. Do you get it? Now, let me make it clear that this 4% that is taken aside on USD JPY is for people that registered their account with a leverage of 1:100, which we normally say standard account. So if you registered your account with a leverage of 1:100, which is normally termed as a standard account, or if you didn't take notice of this and then you just selected standard accounts during your creation of account, then it is you that this 4% is taken on your account anytime you trade USD JPY. Is that okay? So if your account is not a standard account, meaning if your leverage is not 1:200, but more than that, we have people who choose 1:200. There are people who will choose 1:400. So if your account is not standard, but above the standard level, then you should know that you will need more margin. Oh my God. I'm telling you what you might have not heard before in Forex. Once I'm done, you can go and start doing your research. I wouldn't come on this channel to lie to you. I just want to tell you the reality. You want the reality, right? So if you want the reality, subscribe to this YouTube channel, hit the notification bell, because I have just started talking about things you need to know in terms of tutorials. I just want to give you that. Okay? So if your account is not a standard account with a leverage of 1:100, you should know that you will need more margin, because yours is maybe 1:200 or 1:300 or 1:400 or even 1:500. There are people like that who choose this leverage. And then also we have people that takes leverages that are lesser than that. So 1:50. Some will choose 1:30 and the rest, etc. I just cannot go into all these with you. I just want to take the standard account. Please. Standard account, which is with a leverage of 1:100. That is what I want to talk about. Please forgive me that I can't go into the rest. But Forex trading is all about knowledge. You need to acquire the knowledge before you begin to, excuse my language, waste your money. Yes. You need all the knowledge before you waste your money. If you want one-on-one tutorials, which will be different from what you have read or seen, if you want mentorship, I am ready for you. You may only pay just $100. And I'll give you all that you need to know. I'll have one-on-one trading session time with you, give you the tutorials you need. Maybe you may not be able to wait for all the videos that will be coming on this channel, but you want one-on-one mentorship, training. Please, the cost involved is just $100. If you are ready, I'm ready. All you can do is send me an email, and my email address is leadingforexgh@gmail.com. So send me a message if you are ready. I mean, those who are ready and serious for tutorials, exclusive tutorials. leadingforexgh@gmail.com. You send me an email, I'll respond. And then you make payment, we take it from there. Now let's get back to business. We're talking about margin. I just want to add something small and leave this video as it is. Okay? Now, like I said, 4% is only set aside on standard accounts. So 2% on Euro USD is for standard accounts. All the percentages you saw, Euro AUD 3%, GBP USD is 5%, collateral or margin is all for standard accounts. So take note of that. Now you need to ask yourself, what is 5%? This 5% that is going to be set aside, what is it? This 4% that is going to be set aside, how much is it in real money, in terms of value? How much is it? We need to know. And I'm just going to do one calculation, and then maybe another time we'll look at the rest. So when we say 4%, you need to ask, what lot size are you going to use to trade? You want to buy or sell USD JPY. Okay? What lot size are you using? When it comes to lot sizes, we have the standard lot size, which is 1.0. We have the mini lot size, which is 0.10. We have the micro lot size, which is 0.01. And then we have the nani lot size. The nani one is 0.001. 0.001. And the 0.001 is mostly for cent accounts. Cent accounts. So mostly those with the nani lots will use cent account or will create a cent account. But with standard account, you need to either use a lot size of between 1.0, 0.10, and then 0.01. So in between this and this, okay, please let me clean this and do it again. 1.0, 0.10, okay, 00 to make it look nice, and then 0.01. Between these two, between the 0.10 and 0.001, if you choose any lot size in between this, you have taken what is called a micro lots. Micro lots, okay? That is a micro lot. So between this and this, any lot size you choose is a mini lot size. And from 1.00 and above, whatever you choose is a standard lot. Okay? So in between this, you have a micro lot. In between this, you have a mini lot. And then above 1.0, from 1.0 upwards, is standard lots. Is that okay? Let's continue. Now, let's assume we want to use a mini lot. Okay. We want to use a mini lot, which is going to be 0.10, sorry. Okay, 0.10. You want to place USD JPY with a lot size of 0.10. This is the lot size we want to use. Is that okay? I want to make this video very short. I don't want you to take too much time to read it or to watch. So let's make it short. Now, you need to know this lot size. what it is. Now, once you decide you want to use 0.10 lot size to place this trade, USD JPY, what it means is that the 0.10 is going to be equal to 10,000 units. Now, lot sizes are measured in units. Lot sizes are measured in units. So, only lot size can take 3 episodes. But I want you to know that lot sizes are measured in units. So, if it is a mini lot, every mini lot you are using 10,000. If it is 0.10, then it means you are using 10,000 units. So what it simply means is that if USD JPY, if you buy or you sell, so let's say you buy USD JPY with a lot size of 0.10, what it means is that you have bought 10,000 units of USD JPY. And so if you have bought 10,000 units of USD JPY, how much money will be set aside? 4%. Is that okay? Because this lot size, it's only a standard account you can use this lot size. So USD JPY 0.10 is the lot size, which literally means that you are buying USD JPY 10,000 units of USD JPY, of which it will attract 4% of your trading account, which is the margin that will be required. So let's do the calculation. This is where you need to take your time. So 4% of a lot size, which is 0.10, which you know is equal to 10,000 units. So 4% of 10,000 units will give you what? 4% of 10,000 units. Is that okay? So let's do the calculation. This 0, 0, 2 zeros will take away 2 zeros here. So we are left with 100. So 4 times 100 will give you 400. Is that okay? Yes. So 4 times 100 will give you 400. So what it simply means is that once you buy or you sell USD JPY with a lot size of 0.10, an amount of $400 will be set aside on your trading account. Yes, this is what it is. Once you buy or you sell USD JPY with this lot size here, that means this amount of money is going to be set aside from your trading account. So let's assume you have $1,000 in your account. Before you place a trade, if you want to buy, let's say you have seen a good buy trade for USD JPY, on your 1,000 account, if you are going to use a lot size of 0.10, you know that at the back of your mind, your $1,000 balance account, $400 is going to be set aside. So if 400 is set aside, how much is left? You are left with 600. So when you place 2 of these trades with a lot size of 0.10, and then you go for 2 trades, it means another 400. 1 trade is 400, so the 2 trades will be what? 800. So if $800 is set aside from your $1,000 account, how much are you left? You are left with just 200. So you realize that if you want to place the third trade, if you want to place a third trade for the same pair, maybe you decided you want to give 3 trades to the same USD JPY. So you realize that once you place 2 trades and you want to add a third one, you will enter the third trade, and then the broker will reject, or the platform will reject the third trade. They will tell you insufficient funds, or they will reject the trade because your balance is just left with 200. because you have already used $800 for collateral. So you are left with just 200. And so to place the next trade, which will be 0.10, you need additional 400. But your balance is not up to 400. So your broker will tell you you can't place the third trade. So you try to place the third trade, they'll reject it. You try, they'll reject it. You try, they'll reject it. And then you'll be like, what is happening? Why can't I place the third trade? Or sometimes you realize that you choose a certain lot size, and then you enter that lot size in the market, and then the broker will reject that lot size, will tell you insufficient fund or you can't enter that trade. The reason you can't enter that trade is because the collateral that will be needed for you to enter that trade is not up to what you have in your account balance. It means your account balance is less than the collateral that will be needed. And that is why you chose that lot size and you entered and then they rejected it. So they'll keep rejecting. And when you begin to reduce your lot size and you reduce it to a level that will be enough for your account balance, immediately you enter that lot size, you will see that they will accept it. You will place and then the trade will go through. It means that you have selected a lot size which has a margin equal to your account balance or is okay for your account balance. That is why the trade went through. But if your lot size, the collateral that will be needed for your lot size is more than your account balance, they will always reject it. Now, if that is the case, then how come you receive what is called margin call? I'm sure your broker keeps telling you this whenever your trade is closed or whenever you blow your account. Your broker will tell you received a margin call. That is how come you were stopped out. Now, I'll explain this maybe in another video, but before I go there, let me tell you this. Once you enter that trade, the USD JPY trade, once you enter that trade and the 400 is set aside, if you begin to make profit, okay? Now, this is where I want you to pay attention. If you begin to make profit, your margin will remain the same. And if you begin to lose, your margin will begin to also reduce. So, if you are making profit, once the trade is making profit and it is not closed, your 400 collateral is safe. But the good news is that the profit that you are making at that moment will be giving you some extra margin because you are in profit. But if you are making losses, your 400 will also begin to reduce because you are making losses. So whilst your $400 begin to reduce because you are in a loss, what your broker will be doing is that the $1,000, let's say this, you had $1,000 in your account and you only place one trade. Let's assume you only place one trade of USD JPY. Sorry, JP. I mean, what can I do? So you have $1,000, okay, and then you only placed one lot size of 0.10 for USD JPY, okay. Now, it means 400 was set aside, so you are left with 600. Is that not it? Now, immediately you begin to be in a loss. Once you begin to make losses, what will be happening is that your broker will also continue taking the reserve money left, the $600 left. Your 400 is already taken aside and you are in a loss. So whilst the loss comes and then this 400 begin to reduce, they'll be subtracting or taking money from the remaining 600 and then they'll keep on adding to make the 400 still stand. I don't know if you get it, but let me say it again. You have placed only one lot size, 0.10, and the 400 was set aside because that is what you need to keep this trade running. But the trade is running and you are in a loss. It means immediately you begin to go into losses, your 400 margin also begin to reduce. So whilst it begins to reduce at this point, your broker will make sure that if it reduces to $300, your broker will come and take the remaining 600 you have here. Your broker will take 100 and top it up, making it the same 400 again. So at that point, your 600 is no more 600. You are left with what? 500. So the more you continue to lose, let's say your 300 is no more 300, but you have lost more, and so your collateral is now left with 200. If your balance was 600, your broker will move 200 from here to add up to this 200 to still get the 400 that you need as collateral. So it means at this point, your account balance is reducing. Your collateral, which is left, is reducing. So at this point, you do not have 600 here. You now have just 400 left because you are in a big loss. So the broker will keep on reducing. If you are in losses, they'll keep on taking more collateral. It means you need more collateral to keep your account running. More collateral until you do not have anything left in your account. So if you do not have anything left, your 1,000 is still standing. When you check your balance, your $1,000 is still 1,000. But when you check your margin, you see that the margin level will reduce. Once the margin level reduces to the point that you don't have anything left in your account that will be used as a margin to keep your $400 margin to allow the trade to run, you will see that your margin percentage will begin to go into negatives. It means you are running out of margin. So once it begins to go into negative, your broker can only allow the negative to run up to a certain percentage. And some brokers will allow your margin to deplete up to 70%. Some brokers will allow your margin to deplete or to reduce up to 100%. Some can only afford 60%. So you need to know what percentage will your broker allow your margin level to reduce up to once your total margin is finished. And then the remaining 400 begin to reduce, and it reduces up to 70%. Once it reduces up to 70%, which your broker says he can only accept up to that level or accept up to that level. Once you reach 70% and it comes to 69%, then your broker will automatically close you out of the market. If your broker says they can only wait up to 60% of your margin, then once your margin, the 400, you don't have any extra money to top up to make this 400 still stand. Immediately this 400 begin to reduce and it gets to 60. The next moment it gets to 59%, your trade will be closed automatically. Is that okay? Good. Immediately, if it is 100% margin, then you are lucky. Then it means that your 400 that has been set aside, which you don't have any money to add up to keep the 400 stand, that broker will only wait for the whole 400 to go. Once the whole $400 is gone and you now have 0 margin, then your broker will close your trades. Your broker will close your trades, will close your trades, will close your trades, will close your trades, will close your trades. If you love what I have just discussed, subscribe to this YouTube channel. Subscribe. I have more videos for you. I don't want to rush this. I take my time to search on the internet and see what people are not saying. Then I come and tell you. So today, you now know what margin is all about. There are more I should talk about in terms of margin. There are a few more things I need to talk about in terms of margin, but I'll leave it here. This is just a part 1 of margin alone. I can talk about it again another time, maybe with a part 2, and then maybe in another video, a part 3. Because what of currencies that have euro, for instance, euro USD? So in the part 2, I may be talking about base currencies. The part 2 of the margin, I'll be talking about base currencies. And then in the same part 2 or maybe part 3, I'll be talking about what we call your account denomination. Your account denomination. What currency did you use in creating your Forex account? Is your Forex account in dollars? Or is in pounds? Or is in any other currency, euro? Or what currency is your account? That is the denomination. So the denomination also have something to do when it comes to margin. Yes. And then your base currency, any currency that you want to choose. Let's say you want to sell maybe GBP USD. The base currency is GBP. If you want to sell Euro USD or Euro AUD, the base currency is Euro. So in terms of margin, what does the base currencies also do? And then what does the account denomination that you have on your account, what does that also do? Or how does that also affect when you place a trade? What does the denomination stand for in terms of margin? What does the base currency stand for in terms of margin? Maybe in my next tutorial, I'll be giving you a part 2 or a part 3. Until then, this is Leading Forex YouTube channel. Thank you for watching. I'll see you in another video. Take care. If you have questions, leave them as comments. Or you can send me an email. If you are ready for us to take tutorials, I will ever be ready to help. Thank you.